Hi, this is Todd Moerman. This is Q3 quarterly market review for Integrity Investment Advisors. Hope everybody's doing great and had a fantastic summer. My goal here is to quickly move through this slide presentation about the quarter and where we stand year to date. I'm going to move quickly. You guys can pause the video and move back if you need to repeat something. And we'll also have a copy of this in a PDF format where the numbers may look more clear just because of the image quality on YouTube video. But we're going to move quickly, and some of the slides towards the end will be reference only. As you can see with this quick narrative here, Q3 was a very good quarter. U.S. stocks were up 6.35%, international up 11%, emerging markets were even up for the quarter. Global real estate investment trusts were down slightly, and the bond market was close to flat, slightly positive. Here is a timeline of events for Q3. As you can see, much of the quarter was dominated by a Federal Reserve and policy talks. They decided not to taper at one point in time during the run-up in the quarter. Dow Jones made some replacements into the Dow Jones average. And as we ended the quarter and move into Q4, much of the topic today is around the debt ceiling. We are 10 days into the government shutdown, and it looks like they're working to get some of that resolved in a positive way for the markets. I'm going to back up here to a more macro level for some of the things that we work on with clients and prospects. And really, from our standpoint, it's all about focusing on what you can control. So from a macro level, it's about customizing an investment plan, structuring the portfolio around dimensions of returns. And I'm going to spend a couple slides talking about some of the new dimensions from an educational standpoint. Global diversification, reducing expenses and turnover, and minimizing taxes. I really feel most investors do need a coach to help them through this process. From a business standpoint, this is what we work with our clients on, and where I think we provide value is in three critical areas: goals, strategy, portfolio design, and execution; coaching and helping the client define reality in terms of their own retirement and where they stand; helping people avoid big mistakes; and then lastly, you're going to see several slides here coming up. We provide access to dimensional funds, which is institutional and very academic and scientific how they approach investing. So with clients, we spend a lot of time talking about dimensions of expected returns. And this is based on research from dimensional funds, and it's from 1975 through 2012. So a good 37 years worth of data regarding this. And basically, if you work with an advisor or you try to do it yourself from an investing standpoint, we believe this is one of the best ways to approach building a portfolio for clients. We think everybody should approach it in this manner. Basically, there are four factors that are academically proven areas of expected returns. And those are a market factor, which is stocks versus bonds. And over this 37-year period, stocks have outperformed bonds on an average of 8.14% per year. Again, we tilt portfolios towards small cap companies, and small cap companies have outperformed large companies on average by 3.73% per year over this period. We also tilt our portfolios towards value companies, and value companies have outperformed growth companies on an average of 5%, 5.08% per year in this study. And the newest factor that Dimensional is just now integrating into their portfolios across the board is expected profitability. And I can send you a paper on it if you want more information, but basically expected profitability, high profitability companies have outperformed low profitability companies by about 5.63% on average over the period. And these are the four factors that we build the equity model in clients. And if you're using Vanguard or you're using American funds, this is what your advisor should be looking at. If for some reason you're not, looking at these dimensions, you're probably missing out on some returns that should be in your portfolio. So with dimensional, what we end up doing is we are fairly active with how we run the mutual funds from an investing standpoint. Very different than indexing. This is designed to produce higher expected returns because of how we segment the market. So quite simply, here's your entire market portfolio. DFA will come through and start to segment the portfolio into large cap versus small cap. And then looking at value companies over here, again, keeping small cap and layering in these different dimensions of expected returns. And then the last one is direct profitability. So you have value companies, small cap companies, and as you can see the other little dots, these are highly profitable growth companies, which we're adding into the portfolio mix. All of this is designed to give better expected returns than, say, a simple S&P 500 index or some of the Vanguard indexes. All right, so a couple other things here. At the end of Q3, we remarkably are in very good shape from an economic standpoint and really from a return standpoint. This has been one of the best recoveries in the past 10 recessions. As you can see here, household net worth is at an all-time high. And one of the other components of this is U.S. household debt service. So this is the cost to pay household debt is close to an all-time low. And this is because many people have refinanced, mortgages have come down, people have paid off debt over time. All right, so on a year-to-date basis, I'm going to walk you through some of these charts and why we look at them this way. But the quarter was a very good quarter. You can see here the S&P 500 was up about 5.2% for the quarter. Mid-cap and small-cap companies were up a little bit more. On a year-to-date basis, the S&P 500 is up 19% on a year-to-date basis. And again, you can see small cap and mid cap have performed better. To give you an idea here, on a year-to-date basis, some of the high dividend ETFs from Vanguard are up about 17 or 18%, sort of in line with what the S&P 500 is. And the numbers here in blue, this is the DFA large cap value mutual fund, is up about 24%, almost 25%. The mid cap value fund is up 27.92%, and the small cap value from DFA is up 27.44%. So you can see by tilting the portfolio towards value has been very productive in the dimensional model. So from the October 2007 highs of the market, we have obviously overachieved those. Again, when you follow the indexes, growth has performed a little bit better across the median from the 2007. When you look at from the March lows of 2009, you can see it's been fairly balanced between growth and value, with mid-cap and small caps really outperform. Again, these materials will be in a PDF if you want to download these, but these are asset class returns on a year-to-date basis. You can see it's been a very challenging year for fixed income bonds, and probably when all said and done, it'll be one of the worst years for bonds in the last 30 or 40 years. As you can see, this is a large company. This is a proxy for the S&P 500, up about 19.7%. Large cap value up 24, almost 25%. And then small cap and micro cap up 30 and 27%. Again, it was a very good quarter for international markets. As you can see, large cap value up about 16%. This is year to date. And small cap value up about 22%. Emerging markets continue to struggle for the year, and real estate investment trusts are slightly positive for the year. Okay, so a couple other things. Obviously, the Great Recession, way down here in March of 2009. It's been an amazing run here. Where we're at today, ended the quarter at about 1682 on the S&P. Forward PE of around 14 times, 14.3 times. And right now, much of the daily movements in the market are related to Congress and budgets and the debt ceiling. Again, all of this is driven by corporate profits and corporate earnings. This slide gives you some approximations on where we would be from a PE standpoint at different levels. As a reminder for people who are used to seeing my blog, at the end of the quarter, we were up about 18% on a year-to-date basis. A pretty good year. We've had a tight trading range. At most, it was off about 6% during the course of the year so far, but a very good year to date, and with 1 quarter left to go. As a reminder, recessions do happen on a fairly regular basis. I had this slide in the last one, and I think it warrants continuing. Typical recessions on average have been, outside of the Great Depression, have been about down 24%, 24.5%, and they have lasted about 15.2 months. Our last 2 recessions were close to 50%, each of them. So keep in mind, this is why we have a fairly consistent investing plan, well-disciplined, and we stay with our plan and continue to dollar cost average in good times and bad. Bonds in the portfolio, although bonds have struggled quite a bit this year, bonds serve a very important role. Again, this is over the last 80 years or so. And about 90% of the time when stocks are negative, in the blue here, bonds provide a positive return to your portfolio during those times. So bonds provide great diversification and security in challenging times. Okay, the rest of these slides are really what happened in the quarter, and I'm going to let people look at these by downloading the PDF. I may touch on a couple of them, but this is overall how different asset classes performed during the quarter. As you can see, small caps led the way for the quarter on a standalone basis, followed by value. Here's the Russell 2000 value. From a U.S. standpoint, small cap growth was the best performer of the quarter, followed by small cap blend, large cap growth, small cap value, and so forth. I would say more so than looking at the quarterly returns, I would probably ask you to take a look at the 3-year, 5-year, and 10-year returns. All of these have stabilized and come back to relatively normal historical averages for stocks, especially on a U.S. basis. On the international markets, small cap, again, did pretty well for the quarter. The difference in the lines here is one is U.S. currency, one is local currency. So again, when you bring these dollars back from international investing to the local market, the performance was slightly better because of currency trends for both small cap and value. Actually, across the board, currency trends helped the international investing market. As you can see, the 5-year numbers for international markets, a little bit less, but recovering nicely, and the international market seems to be getting through their European problems with budgets and austerity and so forth. Emerging markets on a year-to-date basis are still negative, and actually have had a very challenging time because of debt and interest rate fluctuations over the last several years. But again, if you look at the back of this presentation in the PDF, there's a detailed page on emerging markets and why it continues to be a good investment, a good diversifier for long-term investors, because there is so much growth, there is so much emerging middle class aspects going on in the emerging markets. Regarding real estate investment trusts, as you can see for the quarter, global REITs were up almost 5% and U.S. REITs were down 3%. When you look at longer term asset class returns, 5 years up 5 to 6%, 10 years 8 and 9%. So a very good asset class and continued benefits of diversification. Regarding fixed income, certainly this year has been a very challenging year for fixed income, as we covered earlier. When you start to look out over the 3 years, you can see probably returns that would be more in line with what we would expect moving forward. Very low return environment with bond yields on the 10-year rising over the next several years was what would be expected. But again, an important part of the portfolio and something we need to have from a diversification standpoint. The rest of the slides, I'm going to let you guys review and download in the PDF. This last slide, I would also ask you to take a look at in the PDF. It talks in detail about emerging markets and the benefits from a diversification standpoint and total return standpoint. If you need any more information or would like any detailed articles about anything we discussed, please contact me. Thank you again for your business. And if you have any friends or family who would like a second opinion, it is free. And really our goal in that process is to help quantify red flags and area of missed opportunity from a portfolio construction standpoint, so clients can make good decisions. Thank you. Enjoy the rest of Q4. And we have about 80 days left in the year. We'll talk to you soon. Thank you.